if we go down and test support down here at this level and it gives way, then it's going to go down. And then if it doesn't and then it bounces, it means it's going to go up. And I think we should talk a lot about technical analysis because we can talk for hours and not say anything.
I love that, and you just made me want to go draw lines on a chart.
Magic lines.
Hey, welcome to Hedge Heads, where we discuss the commodity markets, hedging, and anything related to trading futures. Remember, the risk of loss in trading commodity interests can be substantial. These are opinions only and not trading advice. Well, no one knows where the market's going. We're not afraid to share some ideas. I'm Ryan Tunkseth. He's Jon Prishman. Well, John, we had some email last week, and people were not happy that we missed an episode. I didn't even realize we had listeners, so thank you for sending emails. But where were you? We didn't record.
Fishing. I was doing the important stuff. I was out in the wild as it can get near the Brainerd area.
Brainerd, that's way in the middle of nowhere out there.
Full of cities people on vacation. But it felt like it was the wild. The bite is like a midsummer bite with I think water temperatures were still 70 degrees when I got there, and I'd say normal for this time of year would be 55, so it's 10 to 15 degrees more than normal, which leads us into it's going good in harvest. Very good harvest weather, poor fall fishing weather. I'm sure I'll get my wish here and it'll cool down really soon, but the perfect weather for harvest, and that's why I was able to maybe go fishing, is that it gets so quiet when everybody's that busy at the same time. You don't see that very often, but everybody literally is out in a tractor and harvesting at the exact same time. So quite a year. It dried down unbelievably fast. And to this day, the guys are out there. If I do talk to them on the phone, it's usually in a hurry in between, switching carts out or doing whatever they need to do. They're always on the run and everybody's out harvesting. Going full blast, and you can really tell that on the phones.
Oh, bet it's not quiet at the elevators, and I know you wanted to talk about the elevator today too.
Well, so the calls start coming in, and what happens is guys bring stuff into the elevator. It's just the path of least resistance. So either you have on-farm storage or you don't, and then you might pay for commercial storage. And there's a lot of different programs, a lot of different things going on. And then what we do here is guys that are a little more knowledgeable, they'll call and say, hey, here's what I have. Like today, for example, be 15,000 bushels of soybeans. I don't have room to store them, and so either I'm going to sell them or I need to store them and pay 5 cents a month. So what we do here is we go through the numbers, like what makes sense. Should we sell the grains here after a rally and then look to buy a call? Should we sell the grains, not pay storage, look for a dip in the market and buy a call? Should we store it and look at then paying 5 cents a month? So we go over all the numbers, and what did we decide? What I like to do is it cheaper just to buy a call? So it's basically owning for a limited risk at the money in a certain amount of time. So in this instance, it would be March. So 5.5 months. And it's going to run you 25, 30 cents, just for argument's sake for this guy. So you look at it, an at-the-money call, it was about 40 cents, 11.60 March call, or 10.60. And then, so you're going to pay about, maybe this year on beans, about 14, 15 cents more than you would for storing in that time period. What's the benefits of one over the other? Well, what happens is guys go to the elevator just because that's what they know. It's the easiest path of least resistance. I can just put it there. It comes out of the back end. No money out of my pocket that I can see, although there's fees all over the place, including storage fees and other fees. But it feels good because you don't have to spend any money. It's just like a mortgage. Everything's wrapped in one price that you get at the end. So you got to decide whether you're going to lock in basis, leave that open. You got to decide whether you're going to sell, lock the price in. There's a lot of different things going on there. But you want to go over the numbers, see what makes sense. Now, why would I buy a call in this situation? Well, we have very bad soybean numbers. They look to not improve very much. We'll know a little bit more on Friday. But if you buy a 40-cent option for 5,000 bushels, you're paying this year about 10 cents more, 15 cents more, give or take, than you would for storing it at the elevator. The exact same money out of your pocket. But if beans fall, you don't lose your equity like you do with the beans sitting at the elevator. So it protects your equity. You're still going to pay that 5 cents even if the prices are falling, but you don't lose it on the call. The call value will go down, but you're paying that for storage anyways. So it protects your equity. You use this strategy in a market that you would think would be going sideways or down. You would use the storage at the elevator is probably a smart idea if you thought, hey, I thought basis was going to improve a lot, and I think it's going to be a higher price that's going to offset the storage costs. And in years where that's the case, generally calls are a lot more expensive. So a call might run you 10 cents a month instead of 5 cents. So in that instance, it's going to be better to store it. This year, it's very clear to me what a person should do. If you want to know, give me a call. But there's a lot of, once you even get that figured out, the timing of it. Do you do it the second you sell your soybeans and own a call? Like I say, do you sell your beans, look for a drop going into the end of the year, then buy a call for, spring, summer weather? Or do you buy the call immediately for South American weather forecast shift? That's something that we would discuss personally, and everybody's going to kind of have a different idea on what to do. But super important stuff. But what happens, I find, for the majority of people, they just halt in the elevator and pay all the fees. They don't check on the numbers, and you should start checking. You waste a lot of money by doing this. And it's just, you're very busy this time of year. There's lots going on. Again, it's the path of least resistance marketing. I see guys do that most of the time for most of their marketing. These are things you should really take time to look to if you can improve on. And it's actually very easy to do that. Corn, I think, is going to be cheaper to buy a call this year. I didn't look at the numbers that closely than to store it. But just to store it and ignore it and pay all these fees is really not very good marketing. I mean, some years it's really going to pay off. But just to do it because it's the easiest thing to do is not a good idea. And like I say, I stick with a majority of the people do that because it feels like they don't have to pay any money. But ultimately, all the dollars and cents or the pennies add up. And in a year where it's very vulnerable to the downside, I'd be very worried about paying 5 cents to store this thing. A lot of unpredictable stuff happening, and we just saw that with a broad-based commodity buying. Everybody wanted to know. I got a million calls. What's going on? What they want me to tell them is something changed. This thing's going way higher. But what happened is Wall Street, in their infinite wisdom, just said, "Hey, we want some commodity exposure." And we talked about this a couple weeks ago, where the market's still at full carry, so you got mixed signals. So what's happened is they just simply wrote endless amounts of checks to buy commodities. Cattle, hogs, corn, wheat, soybeans, soy meal, not recently, soy oil, crude oil, heating oil, you name the market, and they've been buying platinum, gold, silver, and they want exposure in the commodities. So they must know something. That's the next thing that people bring up. They actually don't. It's like a pie chart. They think they're cutting interest rates, inflation's going to go back up, thus I'm going to get exposure in commodities. And it's no more complicated than that. People want to think these guys are going to make piles and I should join them. That's not the case at all. Now, it doesn't mean that it's going to stop happening. It could continue on indefinitely. In 2008, they bought oil all the way to $150 on this idea that inflation was going to roar. The dollar index was a lot lower. Corn, I think, went to $8 that year on exceedingly poor fundamentals. But by harvest time, and that was going into the spring, into summer, and there was full carry in the market that year between July and December. I remember it pretty good. But by harvest, we were $297. So no matter what they buy, if the market isn't fundamentally bullish, it's coming back down. And you're seeing on Facebook and Twitter a lot of these charts. And I was kind of making fun of it at the beginning. Oh, this is a super important level. If we can hold here, then we're going to go here. That's ridiculous. There's support levels or resistant levels, but just because it holds for a few days at a level doesn't mean anything. Doesn't mean it's going to bounce. It doesn't mean it's going to go to this level next. It's just people want to make sense of the markets, and they just make that stuff up. Like, yeah, you wanna be aware of your levels and where likely buying and selling's to happen. Obviously breakouts are to be watched and stuff like that. But just trying to predict with magic lines, I think you're just spinning your wheels. I think four professional chart readers look at 4 different ones in 4 different rooms, the exact same chart, and I think you get 4 different answers pretty much every time. One guy's going to see a bearish chart, one guy's going to see neutral, one guy's going to be super bulled up, and the LA Wave guy's going to think it's going to quadruple in value in a few short weeks. That it's just the LA Wave guys are my favorite. But everybody wants to make sense of the market, so that's the easiest way to kind of put it out there. But you don't see buying like this too often, and it's really unpredictable. When they're not buying, look at the grains today. It went down with ease. A lot of hedge pressure. When they are buying, they absorb all that and then some. They've added a substantial amount of contracts. They've gotten either net long most markets or neutral. So that's a lot of fuel for the rally used up. Now the question is, are they going to get net long grains and continue this buying? We have a very good seasonal window for meal right now. So it's not out of the question they could get net long some of these markets. But the truth is no one really knows. We have a lot of grains around. Demand's been good. Where we go from here, I mean, it's just kind of take it day by day. It's a time of year where, yes, it can go up seasonally speaking. Is there a lot of news to drive it? Not with all that rain in South America in the short term. That can change fairly quickly. But just kind of remain, just ready for anything. And this is exactly why I like to market with the upside open. I had some corn stuff that we had, sold some calls, bought some puts, just in case it kept going down. But we have this huge window, and we want it to actually go up. The reason why we did that is because we didn't know what it was going to do, and hopefully it went higher. But if you're selling it, it's that black and white marketing we talk about. It's just done. You have no idea what the South American weather is. So I favor strategies that keep the upside open this time of year, because seasonally that's what it says to do.
That makes sense. On that broad-based commodity buying that you were talking about, and I mean, we've seen it for weeks now. Do you think any of that has to do with the global tensions? I mean, I would say the oil buying had something to do. Wheat on that too.
Wheat for sure. Wheat, that's a familiar story for wheat. Little dryness in Russia, little tension, which I don't know how you figure out that they're gonna buy a lot more from us because of something happening on the other side of the world. Neither of those regions grow a lot of wheat, but that's the way wheat sees it. It just goes up, on that kind of stuff. We definitely saw that with Russia, Ukraine, which made a lot more sense. But you get Middle East tension, and it tends to drive wheat higher. You also have had the Paris wheat futures go up quite sharply. We do correlate quite highly to that, and they've had a poor crop. So you got a few stories going on in wheat, but absolutely, the Middle East tension for sure with oil. But I also think that it sold off, $3 a day at one point, $3.60.
It was down over $4 at one point.
And
I don't
think
know what it finished at.
The broader economy. I mean, you have a huge hurricane bearing down in the Gulf again, and normally with a tailwind like we've had with oil, we should see that going higher. But I think that the real economy and the kind of the ugly numbers we've been seeing shows that oil is kind of the leader of that, and then it goes back and forth, which has made it a really difficult market to trade. Because 1 minute it's trading what maybe they see as a cooling off world economy, and the next minute China stimulus, constant commodity buying, Middle East tension, and a rip and it goes. So it's been a really tough market to get involved in. I've had some luck. There's some guys that sold puts, when it had dipped quite a bit. They were fighting those for a little bit, but now those got to be profitable. But you want to be real cautious in the energies right now. Lots of moving parts there, and very difficult to predict what's going to happen. But I think, I don't know that you mentioned it when we were talking, but the fact that you see oil going down is probably that the Middle East tensions are getting better. See, we're not going to be privy to that news. You're going to see it in the price action well before you actually hear about it. But I would guess that it's going better than it's gone, and to have that kind of sell-off. And but boy, that's been a volatile market for sure.
There's definitely been movement around there. Do you think, I was going to ask also, I mean, speaking on the crude oil and diesel or that side of things, you talked about on the elevator factoring in storage, looking at options, looking at pricing, running numbers on that. Is that also true when we look at the other things that we may hedge, like our diesel or heat? On your input side, do you run numbers on that? Or
yeah, all the time. And there's been mainly discussed. Guys do not want to pay these numbers. You see natural gas way down there. Nobody wants to. No one likes the numbers at all. I've had a few guys call, especially around this region. They're not happy with what they're seeing so far. I don't see a lot of guys locking stuff in at all. I get a good feel for what guys are kind of thinking. Of course, it's in constant motion, but yeah, they don't like what they see, and I think most guys are going to wait. That gets to be a really important thing. A couple years ago, they had that big scare where we weren't going to have any fertilizer because of Russia, Ukraine. Lock it in now, or you're going to pay the price in spring. The guys that waited actually did pretty good that year. They avoided the panic. And I wish I did have a chart on that. I think waiting into the spring's been the right answer for quite a few years in a row, or deep winter. But I know guys aren't happy with the numbers of the grains and the input costs for next year. There's been some grumblings there. Absolutely, that stuff correlates highly to natural gas. When natural gas goes soaring, fertilizer costs soar. It's attached to the hip. When there's a glut of natural gas and it goes to zero like now, it has nothing to do with fertilizer prices. It detaches really quick. So that's the one market that hasn't really been moving up. It has a little bit, natural gas. But even this hurricane, you'd think there'd be a little something there, and then you got some cooler in the forecast. But that natural gas market kind of stuck with this glut that we have here. Super important. And I do talk to guys about those decisions quite often, especially on the diesel side of stuff. When to lock it in, what to look at. Is there any hedge strategies here? Sometimes there is. It's a big diesel contract, so there's guys that use it 42,000 or 40,000 gallons, or is it 42? I don't even remember. Anyway, it's a lot. And then there's other guys that use the micro crude oil, which isn't exactly diesel, but I mean it's a big part of where diesel
it correlates somewhat.
It does, yeah.
Yes.
And then we could get into the crack spread, but anyway, it's talked about quite a bit, and it's very important as well in the big scheme of things that can have a huge impact on the farm and farm prices.
Excellent. That kind of brings me to my personal favorite market this time of year, which is cattle. It looks like there is actually some stuff we can look at cattle.
Yeah, I'm doing a lot in cattle right now, and if you want to know what I'm doing, give me a call. There's a wide variety of things I'm looking at, from feeder cattle, live cattle spreads, to feeder cattle strategies. That's been probably the most popular. When you look at feeder cattle versus live cattle, very expensive feeder cattle historically. This good weather and all this cheap feed, I think, has probably put a bid under this market pretty good. Now, you're talking a market, 4, 5, 6 episodes ago, maybe more, where it was an unusable board, right? And we're $14, $12, $14 into cash, and now we're carrying a premium. This is what the board's for right here. When we're carrying these premiums, then the board becomes very important for hedging. So December cattle's been talked about a lot, and here's where I'm really looking for guys, is December 25 on back. You look at the spreads, it's pretty flat. Not a big benefit going to February 26, but I'm looking all the way out to December 25 cattle. So I am quite active in at least talking with guys about cattle. I have a lot of calls to make, but finally a board you can use. What did the seasonals say? It kind of has not been following the seasonals in the least. We went down when we normally would go up, got way underpriced, and then we went up when it normally goes down into fall. And then the weather's been kind of wonky. So it hasn't really been following the seasonals. Last year, I think we bottomed going into December, if I'm not mistaken, and then had a pretty good rally into the winter. But if you want to talk about seasonals, give me a call. We'll talk a little bit more about that. But fairly active in cattle, anywhere from fencing, in the feeder cattle market, looking at some of those strategies, is straight puts, which are very expensive, and some guys are going to short, of course, the board. But picking the right contract and the right time frames is really important this time of year. But finally, a market that is at least decent to hedge with. I mean, it's been kind of a market that's unusable, really. And now the cash market's been great. It's never been bad. But the futures have been terrible, and now they're good. They're better than the cash market.
I did notice that they are still flat. I mean, the front 4 months are nearly flat. I mean, maybe $1.
Yeah, unusual. It's unusual, and that started back about 4 or 5 months ago. That's somewhere where picking the right cattle contracts to hedge. Obviously, you want to do it in the right time frames, but you can $3-4 difference in picking the right contracts. Especially if you're deciding whether you're going to feed it longer or you might sell them as feeders. So you can pick different months in live cattle and feeder cattle. It's not like corn and beans for new crop and old crop. You can feed animals through and go to a live cattle contract. But it's been a good market, but it's definitely benefited from this broad-based buying. Like, they've just bought nonstop. Go look at that chart. Go look at the hog chart. They really, really got exposure. And I do believe they're net long 60,000 cattle contracts. Don't quote me on that, but I do believe they're net long that. So it has some of the things I'm looking for when I'm looking for a hedge. But everything fundamentally looks rock solid with cattle. That being said, it's cattle, and it can give out at any time. I think the economy is going to be where the cattle are going to have problems. I think that's as we go into winter where the demand side of it, which has been phenomenal, is going to be the reason why I would hedge.
We should, you're reminding me of a thought, and I'm going to hit you on the spot with it because I just thought of it.
Hey, all right.
But when I do talk to people about the commodity markets, they always want to talk about money you can make, money you've made. And I point out that when it does come to hedging, it's not about making money on the hedge necessarily. You don't necessarily hedge to make money, right? Yep. Can you expand on, like, hedging isn't speculating? And maybe you don't want to expand on that, but it's not like we have a prospectus like a investment firm, because it's not always the goal to make money.
No. What you're doing is transferring risk to a counterparty. So you have a very bearish corn and soybean year, just fundamentally speaking, and you don't feel like storing it and having all the downside risk. That's where the hedging part comes in. You let's just say you don't have room for 10,000 bushels of corn, so you buy two, or you're going to put it on farm, but you're worried about the downside. You buy 2 puts for 14 cents for the next 2 months, just in case the South American weather is perfect, and there's a lot of downside going into next year. You wouldn't be cheering for the corn you're storing to go down, but you're buying insurance on it because there's a lot of risk there. You're hoping that, not that you're buying puts to lose money, like I hope I lose a whole bunch of money, but you're giving part of your bottom line away to ensure that you don't get a really low price. But you want, right now we have a hedge on for a number of guys where we have short corn calls and then long puts, right? And this is done a while ago. But the idea is that we have this window where to profit. So we don't want our puts to make a pile of money. It means corn's going higher or lower. We want it to go somewhere short of where the call sold, where we thought the top of the market was. We want it somewhere in the middle. So in that one, we'd almost scratch. But on the physical bushels, you'd make a lot more money. But here we would scratch. Where if you just bought a put, it's just like you don't buy fire insurance and cheer for your barn to burn down. It depends on the hedge a lot. And then some guys think of hedging like I'm going to make X dollars on the farm if I just short this contract. And their mind works like a calculator. They're like, if I just do this, I make this dollar amount. You have those guys out there too. But I would say to what you were talking about, mostly guys say they're hedging and they just want to make money. I mean, you run into that quite often where they want the upside wide open, they want the downside covered, they don't want a lot of risk, and they want to make money. I mean, it's never going to change. That's the way people want. That's the natural thing. But yeah, you want to know what your goals in your hedging are, and if you don't know, you need to figure it out before you get in the hedge, because there's some that are extremely complicated to some that are extremely simple, and you want to know what your goal is before you even start, and that's where I'd begin. I mean, what exactly am I trying to accomplish by this? I've had plenty of guys, when you have a hedger's mentality. Like a guy will call, he's out of Ohio, and he'll say, hey, even though I think we're going to lose money on these puts, let's get some soybean puts on it. I'm a little worried about the price. So he goes in there with a mentality, yeah, I'm probably throwing this money away, but if I'm not, it's really going to break hard, and then that's going to protect me. There's not too many guys that really have that mentality, but that is the correct one. You're not going to lose money. You're just trying to transfer risk at smart times, and you're giving up a little bit of the bottom line to do that. That's the simplest way to think of it. Transferring risk to a counterparty.
And that's it's common here when we're talking between somebody who's speculating and somebody hedging, in that we are often talking about the short side of grains.
Yep.
And not that we're cheering for grain to go down, but because that is where the hedge side is, right? I mean,
and most of the time markets go down.
That's true. But if you're on the farm, if you're a producer, you are long.
You're long all the time.
You're long all the time. So if you are going to hedge, you have to look at the downside.
Yeah, and I think when guys start, they're mainly buying calls, and I don't know this, and I have no numbers on this, but they're doubling up on their crop more often than not. They're not hedging, and then there's a lot of misinformation in the business. I mean, there's a lot of bad advice, tons of that, where they're telling guys to do, and they get guys in over their head and not understanding what they're even doing at the beginning. So, like I say, I have a soft spot for guys that want to learn. And you don't have to dive right in at all. To watch it for years until you're comfortable with what you're doing. But the guys that are comfortable with hedging, it's completely different than the guys that don't know what they're doing. Like, it's big business. I mean, you have major corporations hedging their currencies on a daily basis, banks and interest rates. Like, it is gigantic business on a daily basis. Millions upon millions of dollars every day are hedged, especially in the currency and interest rate risk. In the mortgage business, it's a constant thing for giant corporations. Farmers just aren't comfortable with it because, like I said, there's a lot of bad advice. A lot of people get in over the head and they don't understand what they're doing. And they get burned a couple times, or I didn't make money on that, and then, why they do that. But when you start understanding what you're doing with hedging, then you're getting there. I mean, your goal is, like I say, not to carry all this risk. I like to find hedges that have the upside open, cover your downside, and don't have a lot of risk. I mean, that's asking a lot, but that's what I look for in a hedge. So you don't have to make these black and white decisions. I get more phone calls than ever, especially after a rally. Should I sell or should I buy? It's like, how about we look at the 2 or 3 other options that we might have? Now, it might make a lot of sense just to buy or sell, like a lot of times, but then there's other times where it makes no sense to do that, like South American weather. Like, I don't know what it's going to be. No one does. So I want to participate if it goes up, but I also don't want to, because the fundamentals are so poor, I don't want to watch this go down and pay 5 cents a month storage. So you want to try to find that balance where you're at least looking at your options. You don't have to do it, but at least know what's available to you. And I don't feel like there's a lot of people that are there. But, so I'll have a guy, here's how it works. I'll have a guy call me with a specific, here's 20,000 bushels. I need to do this, this, and this with this, or I have to decide by Friday. And then we'll go through the numbers. That's how it works. You're not going to sign up to a newsletter and find it because it's not going to be specific to your farm. You might have an advisor that's more specific to your farm, but you're going to want to have a conversation and go over the numbers and simply choose it, whether it works for you or not. For a cattle guy yesterday, I talked to him and his son. or he was going to talk to his son, but I had talked to him. We had been waiting for the board to come up, and they're going to decide what they want to do. And I think I laid out 3 or 4 different things we could look at. He's going to go back, talk to his son. They're going to call me tomorrow, and they'll apply what hedge makes sense to them. And that's kind of how the business works, or it should work. But I just think a lot of guys sign up to newsletters and just try this cookie cutter. Well, he's saying to do it, then I'm going to do that on my farm. And I just don't, I'm not a believer in that. I think that you got to get to know the guy, and you got to get to know what they're comfortable with. And I also think you should bring the banker in where that's needed. I think that's a super important part of it.
Well, and I think it's fine to speculate too. Like, I encourage that. There is money that you could possibly make.
I do that on a daily basis.
Right?
Yeah, just
we both do. Yeah. But know when you're hedging and know when you're speculating.
Yeah, know what your goals are. Have 2 accounts, which is not hard to get a related account. It's another sheet, and then once you separate what you're trying to do with one, the hedge account versus a speculation account, much easier, and it goes much smoother. Yeah, just know what your goals are and what you're trying to accomplish with this trade or this hedge. And all of a sudden it becomes a lot more clear to you than mixing, hey, I think coffee is going to go down, and then you have some sort of wheat strategy on, and you don't even own wheat, or you don't grow wheat on your farm, and then you have a bunch of corn longs. That's not what you want at all. Like, you want, hey, I think coffee is going to go down. There's nothing wrong with that. Let's do a put in this account. And also wheat, which I don't grow. Let's have that with the coffee. We think wheat's going to go down, and we have our puts on there, and we have coffee puts. And then all of a sudden we have the corn, and there's a hedge in the other account. And then it makes perfect sense for guys. I've seen this happen. When you start mixing everything, it's not good, because then your goals get mixed, and you're just like, oh, I'm down $6,000 in my account today. And then most of it's just on the corn hedge, which you're making in the bin, and you're actually not down a lot on the corn hedge. But so you want to keep it nice and separate, keep it nice and clean, know what your goals are, and there's nothing wrong with either of them. No, we do quite a bit on both sides on a daily basis.
Absolutely. Well, John, we're quite a ways in here, so let's wrap it up here. I am out of town next week, so we're going to skip another week, but it is harvest time. I mean,
yeah, guys are busy. They might be listening to their tractor. It's going to be important decision-making time, so we'll promise to have an action-packed episode in a couple weeks from now.
Well, this one I feel like we had a whole lot of info, so maybe listen to it twice.
Well, there is. I mean, there's lots going on in the markets. They're probably as excited as they've been in a while, which does create opportunities on the hedge side and the speculation side. So it is a lot more interesting suddenly.
Thank goodness for that, because there were a couple weeks there where, especially in cattle.
Yes. Cattle board super underpriced, grains going down every day, but not at prices you wanted to press, even if you were bearish. Yeah, wasn't that fun? Oil not making a lot of sense. Then all of a sudden, Wall Street in their infinite wisdom says we need to own every commodity across the world all at once because we think it's all going higher. And that's what happened. They just bought everything, and they have been for a while. It might continue. So at least they brought some volatility to the market, some opportunities. And phones are ringing when guys have time, and they're asking a lot of questions, especially about storage.
Yeah. Hey, Wall Street, if you're going to buy again, could you call us first?
They like to gaze out their high-rise windows with their arms behind their back, and they're just very proud of themselves that they just told their guy to go buy 10,000 contracts of corn, and they don't really care what it is. I don't think.
Don't they pick up the bat phone and call every other hedge fund and say,
there's a red phone on every hedge fund wall, and they all move together? No, what happens is they triple each other's trigger, and everybody wants to think that they know what they're doing, and oftentimes they lose money. I mean, it's not like they got it all figured out. Now, oftentimes they make money, but there's plenty of guys that stay too long grains. They got long for 2 years. And now there's going to be plenty of guys that stayed short too long, and they lost money. But now where do we go from here? Very interesting stuff, and we'll talk about it in a couple weeks. I think a lot of it has to do with the South American weather from here on out, and I do think we're probably going to have some volatility off that, but I think that's what everybody's going to be watching very soon.
Makes sense. Well, if someone wants to reach you in the next 2 weeks...
I'll be here. 218-731-1578.
Thanks, Jon.
Yep. I don't even need to go to Washington. I'm just going to make up Washington rumors. I think that could be a new job. Just make up rumors. Oh, man, why not?